New inflation data this week is putting the Federal Reserve in a tight spot and could force it to get more aggressive in their interest rate hikes. Will they need to increase their rate hikes to 75 basis points from the current 50 basis point path? And if they did, what would that do to mortgage rates and home prices? We'll be covering all that and more in this month's housing market crash update. Let's get into it. It's been about a month since our last update on when the housing market could crash, and we have new data on inflation, Federal Reserve action, mortgage rates, and housing market supply and demand to consider for our scenarios. If you're new to this channel, my name is Eric, and I am a professional private sector economist in addition to being a licensed real estate agent in the state of California. Today's update is a continuation on my original video answering the question, when is the housing market going to crash? So if this is the first of these videos you're seeing, make sure to check out that one for a more in-depth explanation of how I look at the housing market and under what scenarios we could see a market crash, by how much and when. As in my previous videos, I'm going to give you the high-level summary update first, and then for everyone that wants a deeper dive into the data and what is driving my conclusions, make sure to stick around to the end of the video. So here's where we're at now. The new data this week showed inflation remains at highs not seen in over 40 years, although the annual rate did tick down marginally from last month. This sustained high inflation will put enormous pressure on the Fed to do more than the 50 basis point increase at their last meeting. Fed Chairman Powell said the 75 basis point increase was not something they are actively considering, but after this new inflation data, you better believe they are at least passively considering it now. Because of this, I'm now going to include a scenario where the Fed raises their Fed funds rate by 75 basis points at each of the remaining 5 meetings this year. New real estate data has come in since our last update as well, and home prices have continued to head higher as supply remains tight and demand has not shown substantive signs of weakening. Here's where we stand for the 3 scenarios I'm looking at. The first is our base case scenario where the Fed raises by 50 basis points, which would put mortgage rates at 6% by December and would result in home prices declining by 14% just to maintain affordability for the average household. This was a change from where last month's results were at, where I estimated mortgage rates could hit 5.6% by the end of the year, and the upward revision is due to the big surge in mortgage rates. As of May 12th, the average 30-year mortgage had already hit 5.3% according to Freddie Mac. Our new scenario considers a 75 basis point increase at each of the remaining Fed meetings, which I estimate would push mortgage rates up to 6.4% by December and would result in an 18.1% decline in the median home price by the end of the year. Now, I define a crash in home prices to be 30% or greater, and there are some reasons for that, which I'll get into later. So by that metric, the most likely path the Federal Reserve might take to rein in inflation, going with either a 50 or 75 basis point increase, would result in a significant pullback in home prices, but not necessarily a crash. Which brings us to our third scenario, where we actually do see a crash by the end of the year. In this scenario, it assumes the Fed would have to get as aggressive as they did back in the 1980s to rein in inflation, meaning they would need to overshoot the rate of inflation by 20% in order to bring it back down. To do this by the end of the year, assuming inflation stays at current levels and doesn't go higher, the Fed would need to raise their Fed funds rate by 175 basis points at each of the remaining meetings this year. Mortgage rates would get pushed to 8.2% and it would result in a 31.3% crash in home prices by December. Now, this may sound extreme, but this is the scenario where we could see an actual crash of the housing market. And there is precedent for the Fed to take this kind of action. It's what they had to do back in the 80s to rein in high inflation. For everyone sticking around to the end of the video, we're going to go through all the new data, and I'll walk you through how I arrived at these results. And for everyone else that will be leaving now, please give this video a thumbs up to support the channel. and help it grow. It is much appreciated. And if you haven't already, I hope you will consider subscribing and hit that notification bell down below so you know right away when our next market crash update and other videos come out. I will be releasing full updates at least once a month, and we also have other content throughout the month like our regional market analysis and commentary on what's happening over at the Fed and what that could mean for the housing market. With that being said, let's get into the data. The Consumer Price Index showed an 8.3% increase in April over the same time a year ago, which was slightly higher than analysts expected, but also slightly lower than the 8.5% annual increase in March. There are some who may use this report to say that we've reached peak inflation and that it will steadily come down from here. While I certainly hope that is the case, 1 month does not make a trend, and we will need at least 1 or 2 more reports to confirm this is the case. But there are a few reasons why I think we have not hit peak inflation yet. One is that gasoline prices dipped in April as oil prices cooled off, and that is one reason we saw April's annual inflation rate lower than March's rate. But in May, gas prices have ticked up again, so that component of the CPI is going to head higher. We are also likely to see food prices continue to head higher as there are several problems taking place in global agriculture, such as the war in Ukraine that has the potential to take 1/3 of wheat exports off the global market, a mega drought in the western United States that threatens water supplies and growing conditions for one of the largest agriculture production areas in the world. Then there's a fertilizer shortage that could lead to lower crop yields if farmers are forced to raise their crops without it. And then there are the COVID lockdowns taking place in China that is wreaking havoc on the global supply chain. And the effect from these further disruptions in the supply chain have yet to fully make it through to consumer prices. One bit of good news on the inflation front, however, is that producer prices were marginally lower than the previous month on a year-over-year basis. It came in at 11% compared to 11.5% in the prior report. If we continue to see both producer and consumer inflation rates trend lower as we did in this month's data release, the Fed will be less likely to go to the extreme rate increases in our third scenario, which increases the likelihood that we won't see a full-blown crash in the housing market by the end of the year. It's still too soon to see how the Fed will react to this latest CPI report showing sustained high inflation, but we are likely to see Federal Reserve officials making some public statements in the weeks to come that will give us some clues to see if they are going to stick with a path of 50 basis point rate hikes or if they will start to actively consider bumping that up to 75 basis points or more. The Fed's next meeting to decide on any changes to their Fed funds rate will be on June 14th and 15th, so we are likely to hear from them ahead of time what they think they're going to do, as they've tried to avoid shocking financial markets with unexpected moves recently. Moving on to the mortgage market, the average rate on the 30-year mortgage has continued its upward trend. The latest data from Freddie Mac showed the average fixed rate on a 30-year mortgage came in at 5.3%, up from the 5.1% rate when I did the market crash update last month. We get weekly updates from Freddie Mac on the average 30-year mortgage rate, so it will be something to watch closely each week as we gauge the future direction of affordability for the housing market. Turning now to the real estate market data, let's start with demand. In the latest monthly data from Redfin, a national real estate brokerage, home sales in March did decline slightly for the second month in a row, but this is the first time sales levels have fallen below the pre-pandemic peak since June of 2020. However, this seems more related to a limited supply of homes on the market. The average sale to list price ratio hit an all-time high. The average days on market has also remained at historic lows, so as of March, the demand side of the market appears strong. Let's take a closer look at supply. New listings ticked down a bit from the prior month, but are in line with historical averages. Nothing too crazy happening there, and active listings continued their downward trend as well. So even though mortgage rates have been moving higher, as of March, demand was still strong and supply remained tight, which led to another month of higher home prices. As of March, the median home price came in at $411,000 for the U.S. overall, another record high. Now, let's plug these numbers into our affordability calculations to see where we're at. As of March, the average home payment made up 34% of the median household income, just barely under that historic upper limit of 35%. Now that we've gone through all the new data, let's take a look at what this does to the market crash scenarios. When I first started these scenarios, my base case was that the Fed would increase their Fed funds rate by 25 basis points at each meeting. Well, that scenario's out the door now, as the Fed has stepped it up to 50 basis points as of their May meeting. So a 50 basis point increase is now the base case scenario. I have also revised upward where mortgage rates could go in this scenario by the end of the year, from 5.6% in our last update to 6% in this update. This is due to mortgage rates simply surging over the last few months. The market could be getting ahead of itself in terms of pricing and future Fed action, but that's what we're dealing with right now. Let's see what this does to prices. For those of you new to these videos, or just a refresher for the rest of you, the way I calculate the effect on prices is that I assume the housing payment share of income, my affordability metric, stays at 35%, which I found to be a historical upper bound for the average household. So as mortgage rates increase, prices have to come down in order for that payment not to be greater than 35% of income. In this base case scenario that works out to be a 14% decline in home prices by the end of the year, this is higher than my estimate for the scenario last month because the latest home price data came in pretty strong, so prices would now be falling from a higher base. Now for the next scenario, which is a new addition this month, where we assume the Fed will raise their Fed funds rate by 75 basis points at each meeting, reaching 4.5% by the end of the year. I estimate the average 30-year mortgage rate would get to 6.4% by the end of the year in this scenario, which would then lead to median home prices falling by 18%. That would be quite a correction, but not yet a crash. A decline of 30% or more is what I consider a crash in the housing market, for the sole reason that this is what happened in the 2008 financial crisis. According to data from the National Association of Realtors, of which I'm a member, the median home price fell by 29.7% from October 2005 to July 2011. Round that off to 30%, you have yourself a baseline for what a housing market crash looks like. And now let's get to our housing crash scenario. Not much has changed here, as inflation is basically the same rate as last time, so my calculation of how much the Fed would need to actually raise rates in order to bring it down has stayed the same. When we look back at history, the Fed had to push their Fed funds rate 20% higher than the rate of inflation to bring it down. Apply that to today's inflation rate of 8.3%, the Fed would need to raise their Fed funds rate by 175 basis points at each of their remaining 5 meetings this year, putting the Fed funds rate at 9.5% by December, and mortgage rates would reach an estimated 8.2%. This would then lead to home prices declining by 31.3% by the end of 2022. Now that, ladies and gentlemen, is a housing market crash. And that is where we are now. In the new data, we saw inflation remaining high, mortgage rates continuing to rise. The Fed appears to be behind where they need to be if they're serious about reining in inflation, and home prices continue to reach record highs each month. This is all a recipe for historically high levels of unaffordability in the housing market. It's really hard to see how we're not going to have some kind of correction in the months to come. There are a few scenarios where that wouldn't happen, but I'm going to save that for a future video. I'm still doing some research into that. What do you think? Is there a way for affordability to continue to deteriorate, but prices not come back down? Let me know in the comment section below what you think. Stay tuned in the days and weeks to come as we continue to watch the data and comments by Federal Reserve officials and gauge where we are in these market crash scenarios. So make sure you're subscribed, hit that notification bell down below so you won't miss our next video. And if you've enjoyed this video, please give it a thumbs up and share it with others on social media to support the channel and help us grow. Your support is much appreciated, and it helps me to continue to bring this content to you. Thanks for stopping by, and I'll see you in the next video.